Tyler, should I buy down my interest rate? Well, that's a question I get asked all the time, and I'm going to break it down for you in today's video. When you buy down your interest rate, you're essentially investing up front into your mortgage. Well, let's say if you're going to save $100 a month, but it's going to cost you $5,000 in points. That's essentially, if you divide that number, that's essentially a 50-month recapture period. And so to recoup that $5,000 investment, it's going to take you 50 months before you even break even and start seeing the benefit of that. Because after that 50-month period, you're essentially going to be saving $100 a month for however long you keep that same mortgage or stay in that property. In a higher rate environment than we've been used to the last couple of years, a lot of people are expecting in the next 12 to 18 months there to be a lot of refinance action going on where rates might dip down. And so basically if you had a 50-month recapture period on your points, but then you end up refinancing to another loan 12 months later, guess what you did with those other 38 months? You essentially just wasted $3,800 basically because you never saw the true gain of buying down points. See, points really only make sense in a couple scenarios. Like if we're at historic lows. So last year, for example, when rates were in the 2s and 3s, it made a lot of sense to buy down the rate a little bit because chances are we're probably not going to see that for a while. But when we're at normal historical averages like we are now, it doesn't really make too much sense. However, there are a couple scenarios where it does. So let's say a customer really wants to stick their monthly max budget, right? And the only way to do that, the most effective way, is usually to lower the interest rate. Whereas putting money down, it doesn't usually make that big of an impact on what your monthly payment is compared to how much the interest rate does. So that's one reason why points could make sense if a customer really wants to stay at a certain monthly payment. The other reason is for qualifying purposes. So let's say if somebody is a manual underwrite and they're capped at a 50% DTI and par interest rate has them at 52%. Obviously, it's not going to work. So the only way to make it work is to lower that DTI. And a lot of the times, the most cost-effective way to do that is either pay off your debts or go ahead and lower your interest rate. So again, just let the math do the work for you. Let the math make your decision. Because at the end of the day, don't let some loan officer swindle you into their super low interest rate, but it includes $5,000 in points. Don't fall for it. Let the math do the work for you. Let me know if you have any questions.